For more than 3 decades, I've been investing in the stock market. Over that time, I've been fortunate enough to build millions of dollars in returns. And surprisingly, most of that success came from one very simple strategy. I invested consistently in a low-cost S&P 500 index fund. Historically, the S&P 500 has produced average annual returns of around 10%. The beauty of this approach is that it's passive investing. Instead of trying to pick individual winning stocks, you simply buy a fund that holds shares of the 500 largest companies in the United States. Your money gets automatically spread across companies like Apple, Microsoft, Amazon, and many others. This means even if a few companies struggle, the overall growth of the economy helps your investment grow over time. And honestly, for decades, this strategy has worked incredibly well for me. But recently, something made me pause and rethink parts of my portfolio. That something is artificial intelligence. After researching the rapid growth of AI companies and looking closely at the market, I realized I needed to make several adjustments to my investments. Today, I want to share the 5 major changes I've made to my strategy because of AI. Many investors assume that when they buy an S&P 500 index fund, their money is evenly spread across 500 companies. But that's not actually the case. In reality, the top 10 companies dominate the index. For every dollar invested in the S&P 500, about 40 cents go into just 10 companies. These include major tech giants like Apple, Microsoft, Nvidia, Alphabet, Amazon, Meta, Tesla, Broadcom, Berkshire Hathaway, JP Morgan. That means nearly half of your investment is tied to only a handful of companies. And here's something even more surprising. Nvidia alone receives roughly 7 to 8% of every dollar invested in the S&P 500. Why does this happen? Because the index uses something called market cap weighting. This simply means that the bigger a company becomes, the larger its share in the index fund. So as these companies grow in value, they automatically take up more space in the index. When you examine these top companies closely, a clear pattern appears. Most of them are heavily investing in artificial intelligence. Billions, and in some cases, trillions of dollars are being poured into AI infrastructure, data centers, and advanced computing systems. At first glance, this seems logical. After all, AI could be one of the most transformative technologies of our lifetime. But there's also a potential risk. For many of these companies to justify their current valuations, they would eventually need to generate trillions of dollars in revenue from AI-related products and services. That's an enormous expectation, and it highlights an important reality. Today's stock prices aren't always based on what companies are earning right now. They're often based on what investors believe those companies will earn in the future. That's normal in investing. But when many companies are making the same bet on the same technology, it increases the possibility of a market bubble forming. There's another factor that's pushing these companies even higher: passive investing. Every time someone buys an S&P 500 index fund, their money automatically flows into those same large companies. That pushes their stock prices higher. As their prices rise, they become a larger percentage of the index, which means the next wave of passive investments sends even more money their way. It creates a self-reinforcing cycle. More money flows into the biggest companies, which makes them even bigger. This doesn't necessarily mean the strategy is broken, but it does mean investors should understand how concentrated their investments might be. For the past decade, the U.S. stock market has dominated global returns, but history shows that leadership in global markets changes over time. At different points in history, the United Kingdom dominated global markets in the early 1900s. Japan became incredibly powerful in the 1980s. Today, the United States leads the world. But no country stays on top forever. That's why I've started allocating a portion of my portfolio to global index funds that invest in companies around the world. This gives exposure to thousands of businesses across Europe, Asia, and emerging markets. The goal isn't to predict which country will win, it's to own a piece of the entire global economy. Another opportunity I see is in small and mid-sized businesses. Many of the largest tech companies are spending enormous amounts of money developing AI models, but there's another side to the AI revolution. Smaller companies don't need to build the technology themselves. Instead, they can use AI tools to improve their products and services. These companies can adopt AI to increase efficiency, reduce costs, and create innovative solutions without taking on massive debt. Sometimes the biggest opportunities aren't with the companies building the technology, they're with the companies using it in the smartest way. Technological revolutions often bring economic uncertainty. That's one reason I've increased my allocation to gold. Gold has been used as a store of value for thousands of years. Recently, central banks around the world have been increasing their gold reserves. In fact, gold has now become one of the largest reserve assets held by central banks globally. This growing demand could support gold prices over time. For me, gold isn't about getting rich quickly. It's about protecting wealth during uncertain periods. Another adjustment I've made is holding slightly more cash. This might sound boring, but it can be extremely powerful. If the market suddenly drops, having cash available allows you to buy investments at lower prices. Even legendary investor Warren Buffett is currently holding massive cash reserves. Sometimes the best move isn't to invest every dollar immediately. Sometimes the best move is waiting patiently for the right opportunity. The truth is, no one knows exactly how the AI revolution will play out. It could lead to enormous economic growth, or it could create market volatility. That's why my strategy isn't based on predicting the future. Instead, I'm preparing for multiple possible outcomes. Most of my investments remain in the stock market, including the S&P 500, but I've also diversified into global markets, smaller companies, gold, and cash reserves. This balanced approach helps me stay invested while also protecting myself from potential risks. One of the most important lessons in investing is this: markets are unpredictable. Technology changes. Economic leadership shifts. New opportunities appear where we least expect them. Instead of trying to perfectly predict the future, successful investors focus on building resilient portfolios that can grow during good times and survive during difficult ones. Because in the long run, wealth isn't built by guessing the next trend. It's built by staying invested, staying diversified, and staying patient. The AI revolution will create winners and losers. The question is, which side will you be on? If you found value in this video, subscribe and join me as we break down money, markets, and mindset, one smart decision at a time. And remember, wealth doesn't begin in the market, it begins in the mind.